Hi everyone, welcome to the Timing Research Show for July 27th, 2015. My name's David Kosmeter. I am the creator of Timing Research, and today we will be talking about the 96th weekly report. If you haven't had a chance to take a look at this yet, just go to TimingResearch.com/reports and you can download it there. I have Dave Landry hosting for me again this week, so I'm going to go ahead and turn it over to him.
Thank you, David. And thanks to Timing Research for having me back again this week. This week we have Jason Jankovsky of theliononline.net and Neil Batho of TraderReview.net will probably be joining us in just a few minutes. Jason, while we're waiting on Neil, tell us a little bit about yourself for those of us who don't know you, and tell us a little bit about your trading.
Sure. Well, for those of you that aren't familiar with me and what I do, I've been in the business since 1986. I started as a customer. Trading, if I told you where, you probably would laugh, but I traded initially in futures and options on futures. I traded Chicago Board of Trade, big board corn was my very first trade as a customer. And over the years, became registered in the business as a Series 3 commodities broker. I'm not currently registered. I don't handle customer money or work directly with management of funds anymore. I trade only my own accounts, and I do education and training with focus on the psychology of trading. My client base, people that have asked me to help them with fine-tuning their trading edge, their desire to make more money in the markets or improve their gains or flip the switch from lose to win, those clients, the ones that I've been able to earn, a lot of them believe that and understand now that the psychology, how we see things, how we think, our psychology behind how we choose to make our choices, how we see opportunities, why we're buying, why we're selling, that is as important as anything else. And so I've chosen to focus my education and training on the process of psychology.
Yeah, but, absolutely. Absolutely.
Just, I think for the clients that don't really know me real well, the most important thing I can tell you is that I learned this business from the inside out. I started just like you, just as a customer trying to figure out how to make this happen.
Yeah.
And been at it ever since. Love it.
Yeah, no, fantastic stuff. Yeah, I plan on doing a course on psychology, and I thought it'd be like a quick little Saturday morning 4-hour deal. And I started putting together the information. I've got like 10 pages of stuff that I want to cover. It's just it's amazing how much needs to be covered there. And
it's huge, yeah.
Yeah, what's standing between you and your success a lot of times is you, and it's amazing. And on the retail side of my business, even on the institutional side, I get to see a lot of mistakes, and I make mistakes, of course, on my own. It's amazing how much just psychological mistakes are there. I know people that have been at this for 15, 20 years, and they're still not successful because they keep making the same mistakes over and over again. And if you ask them what they're doing wrong, they'll tell you what they're doing wrong, and you tell them, well, just don't do that, But it's
right. It's not that easy because
it's not that easy, yeah.
Right. They don't have a control mechanism in place yet. That's it's really interesting that you would say that you started to say I'm going to do a thing on psychology of trading, and I realized once you got into it how that could go a long way. I did the exact same thing. Right now, currently, I just improved my course offering for this year, and it's 8 weeks long, and it is a tremendous graduate level course. I mean, I could see where, it's a deep immersion process that, if you're going to do it, you probably have something of value to offer us. That's if you're going to put that time and effort into it. But if it runs away from you and gets to be some huge amount of time and effort, don't shy away from that because that's really what it takes.
Well, I appreciate the vote of confidence, but yeah, I was thinking that it's funny you should say that your 8-week deal because I was thinking the same thing. I might have to do this over
right. Well, it didn't start off that way. It didn't start off that way,
Yeah. Okay, for those of you guys who don't know me, like Jason, I was a CTA for a while. I was a CTA for about 15 years. I've been in this business for, I stopped counting around 20 years, so I've been at it for a while and worked on both institutional and retail side. Right now, I'm CEO or president, however you want to look at it, of DaveLandry.com, and I can be reached at dave@davelandry.com. My methodology is fairly straightforward and very simple. And like Jason and I were talking, psychology is a big part of that. When it comes to predicting the markets, I think you can only predict the short term. Some people have kind of misconstrued that into me thinking that I can predict all markets all the time, and that's not correct. You can predict the short term would you have a setup in place. And the analogy I use is like predicting the weather. If it's cloudy and thundering, you know it's going to rain soon, but you don't know if it's going to be raining this time next week or next year or whatever. So you could have the position management and money management in place to take a small piece off of that short-term gain and then hang around just in case a longer-term trend ensues. I have a free report on my website. You can find it usually in the sidebar on the right, sometimes on the banner ads, or you can just go to my products at the store, and it's the first thing in the store that's free. But this 21-page report, and it pretty much sums up the entire methodology. The rest is just some details here and there. But if you understand that report, you understand the methodology. And then while you're there, go ahead and download the rest of the free reports. Jason, while we're still waiting on Neil, let's go to you for the question this week, or the question number 2, I should say. Based on any technical or fundamental indicators you want to use, would you predict that the S&P 500 index will move higher or lower by the close of this week, and that's Friday the 31st? And then once you give us your up or down, give us a confidence on a scale from 0 to 10, with 0 meaning no confidence, and that's a 50-50, believe it or not, the way the scale is made. So if you say 0, it could go either way, and then 10 would be extremely confident. Obviously, you'd be 100% correct in your confidence.
I would say, based on what I like to watch with regards to the health of stock markets, it appears to me that all the stock markets are still very highly coordinated or correlated, with the exception of what's been happening overseas in Asia. And I believe that that's basically the inevitable correction that is due. I don't think it signals the end or the reversal that everyone is planning on or hoping for, expects to have happen at any minute. So from what I see, I think we're in the middle of a potential pullback that's going to be used by professional money to buy. And just looking at what I look at, I don't see anything technically or fundamentally that violates the current uptrend. All we've got right now is a little pullback off the highs. And I think on the larger time frames, daily, weekly, monthly, there's nothing about what's happened yet that is a violation of any of these trends that have been in place for years. So I think pullback could go run a little bit deeper in the S&P this week, but I think that's going to be used as a buying opportunity. I would say I'm about 50%. We're going to close higher on the week, and the reason I say 50%, it was a pretty substantial sell-off that happened Friday after the rally that happened Thursday last week. So, I mean, there is some interest to sell here, but nothing's violated. So, could it be a 2-week correction that comes down to the 100-day moving average and then rallies away? Or, we just touched the 50-day moving average right now, or 50-week moving average, 50-week moving average this week, and it's Monday. We rally through the rest of the week and close higher. I mean, I would say it's an aggressive move to be a buyer today, but if it was a little lower Wednesday, I'd be all over it.
Gotcha.
So we could be higher from Wednesday's lows, but I don't know if we'll be higher from Monday's open. And
okay,
so I'm about 50% on it.
All right, so let me nail you down on your clarity. So you're saying lower this week by the close of this week?
About 50%. I mean, I think it could go either way. It's one of those things where I wish I had more confidence in it, because I know people are really looking for some direction here, but I think you got to buy the dips. I don't think there's anything about what's happened here that, look at the sell-off from 1800 to 17.3, when it's not even violated any of the trends that we've had in place for weeks and months and months. And the Chinese stock market, which everybody's all over, is down some huge double-digit percent. So, I mean, it's not scaring anybody out. It's just their turn to correct.
Yeah.
when that's over, then we'll be, I think, because I don't think the Fed's going to do anything this week, and I don't think that they're not going to do anything necessarily in September. I think maybe one rate hike by the end of the year, but I think a lot of that's already factored in. So, I mean, if the Fed does nothing, no punch bowl's taken away. Punch bowl's even bigger than it was. So that's going to keep right on attracting professional buying. And so I think it's just all business as usual. I think this pullback to start the week is an opportunity to buy. But if you had to put a gun to my head and say, are we going to be higher than Monday's open on Friday, I'd say there's only about a 50% chance of that in my view.
Okay, and we'll give you a chance to elaborate on that in a second too. On the next question, it is a few things I want to dovetail in on what you said, but let's go to Neil. I see he's up and running, and Jason,
Hi,
you
Neil.
mentioned hey Neil, you
Hey.
mentioned the Far East a little bit and China. Neil's the closest to the Far East now, I believe. Are you in Thailand still, or
No, I'm not in Thailand. I'm in Europe now.
oh, you in Europe? Oh, he doesn't stay
Yes.
put. Neil Batho of TraderReview.net, and you have TraderReview.com too now, don't you?
It does. I do. I just didn't want anyone to get the .net. You know how those people are, trying to grab those domain names.
Gotcha. Okay. Neil, tell us, for those of you who don't know us, tell us a little bit about your trading and tell us a little bit about TraderReview.com.
Sure. My trading is technical based. I use point and figure charting. I think I'm one of the experts in the world on that unique type of charting. Using the X and using Ichimoku Cloud, which is getting more and more popular in the West now. It was started in the East. 60s or 70s started to get a little bit known in the 70s, and now people are using it more, and that's basically what I do, just a core type portfolio of around 3 to 8 stocks, and we just time them using various point and figure methodologies.
Cool. Yeah, I always make the point and figure joke. I tried it once, and I pointed the stock and try to figure out why I lost money. But it's actually a very viable methodology as far as it's just support and resistance. And that's what could be more basic than that to show you supply and demand. And I think it's cool stuff. Neil, let's go ahead and get you caught up with us here. Go ahead.
So I just logged on a couple of minutes ago because I had to update my Firefox. Google Hangouts told me to do. So the question is just my outtake on the week, Dave?
Where based on any technical fundamental indicators you want to use, would you predict the S&P 500 index will move higher or lower by the close of this week, which is Friday the 31st? And then once you give us your prediction, give us a confidence on 0 to 10.
I would say that the S&P is going to be down at 1 p.m. on Friday, and if it's down all week, you gotta start looking to buy right at around 2:30 p.m. Because if you get a 5-day down move in a market, I've seen it happen so many times. Called the 2:30 turn, 2 or 2:30. If you're a short-term trader, you gotta cover your shorts, maybe even look to buy some calls. But I'd say down 60%.
Okay.
Down for the week.
Cool. I'm going to say that we're going to head higher this week, and I don't have a whole lot of confidence in that. Other than number one, I think we're oversold, and number two, what I've been doing for quite a while is I like to err on the side of longer-term trend. So far, the 200-day moving average has held. We actually nailed it this morning in the P's, the S&P 500. So. Not that that's a line in the sand, but it also corresponds with support around 2050, 2060. So as long as that holds, I'm not a raging bull, but I'm not gonna rush out and get super bearish. I do have some concerns, which we'll get to the next part of the question. I'll elaborate on, but I'm gonna go ahead and give myself a confidence of 5 on that, and then I'll elaborate on some of these things on the next question. In fact, Jason, let's go back to you. You brought up a couple things, and maybe you could flesh those out a little bit in this question. What developing events, and they could be technical or fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets?
Yeah, that's boy, I'll tell you, I always, every time I do the show, I always wish I had unlimited time to tell you what I'm thinking, because there's so many things that are coming together that make this a really critical time for equities traders, in my view. But to kind of give you the nickel answer on what I'm thinking is that stocks do not make one-way moves until they're liquidating. You get corrections and you get pullbacks, and after you've got 4 or 5 days of that, maybe a week and a little bit plus, you've got a buying opportunity. Now that doesn't mean that once it starts to sell off, you don't get 6 months of one-way action like we had when a crash happens, that kind of thing. But what I'm saying is, until the psychology changes, which I don't think it is yet, you you got to be buying the dips, right? It's straight south for 5 days from the 1800 level in S&Ps right down to a technical buy point, and it's holding today. We get a little bit of follow through from the late seller Tuesday into Wednesday. I think that's your buy point. I mean, if we get any kind of sideways action, which you're gonna get that. What happened here today, I think, is because people they really feel they need to see what's going to happen with the Fed every single time the Fed's on the block. They just can't trust the fact that the Fed's going to move when they're ready. It's okay. They're going to raise rates. They can't lower rates. They're going to raise rates. We all know that. There's nothing. What's the big? We know that's going to happen. So when they decide
they
to move,
can pay you to
move.
take the money. They can lower them.
Right. Yeah, right. So what do they do? What are they going to do this month? Who cares? Don't worry. Buy the dip. So I think what's happening is that big sell-off in the last week is liquidating. I think that's long liquidation. I don't think that's new shorts coming in. I think we skidded a little bit lower today. I think a lot of that is due maybe to what happened overseas, but it's buy when there's blood in the streets. Well, we don't have blood in the streets. It's more like a hangnail, but we'll take it. And I think the Greek thing has really worked in. I don't think anybody's even given those guys a second thought. I mean, they're what, 1/10 of 1% of the Eurozone economy has finally been resolved. Okay, fine, move on.
Well,
So
they base their whole economy on yogurt. I mean, come on.
Yeah, the trade deficit is pretty bad for the country, so the money keeps leaving the country. So when the money leaves the country, they just have to put more money in, and it just never stops.
Well, I think the market, the global participants, they're looking for a new headline risk. They're looking for something new to watch, and I think they're a little careful with the upside. I think you get a high volume move over 18.2 or 18.250, the money's going to come out of the woodwork to buy that thing. So I think that all the dips are, I think they're opportunities to buy, and I don't think really you have to be that concerned. I know we're getting a lot of good two-way flows and a lot of volatility, but stocks don't typically move, one way lower unless it's liquidation, and we're not seeing that. This is a pullback because it's a little bit of liquidation from people that are late buyers or day traders. It's not big money liquidating. Big money's buying the dips. So I just think that the fundamental and the technical picture for this week favors buying a pullback, and if Monday's the end of the pullback, you got to be buying on the close today. But again, it could be a little bit lower Tuesday, Wednesday, but I think that they're going to – it doesn't matter what the Fed does because they're not going to do anything. Everybody's figuring September or December, so they'll signal that. So maybe that'll make some kind of volume to the table.
At what point – and this point comes up often in these shows – at what point – and Neil's been around the block a time or two too – what point did the Fed – go from being fiscally responsible to let's do whatever we can do to make the stock market go higher? I remember 15 years ago, you were like crying, please give us something. Okay, we'll give you a quarter a point. And then the market would go nuts and everybody would celebrate, start kissing each other. And then, they just started stepping on the gas in the late 2000s.
That's a good point because, fiscal responsibility is a factor of people's thinking process too. People that are trading in stocks today, some of these guys are people that have never seen a bear market. These are people that have never been through a recession.
Asian crisis, long-term capital management. It's like they never see that.
Yeah. I meet a lot of guys in this business, like you guys do too, and I meet a lot of guys that say, "Oh, things are different now. It's not the same as it was in the 30s." And I'm like, "Oh, okay." That means that there's going to be a major something happen sooner or later. But for right now, their thinking process is different.
10-year cycle with new people coming in. And that's why people always say technicals are going to stop working. It's like, no, they won't, because human nature doesn't change. Neil, before we forget about you, let's go to you. What developing events, technical fundamental, will you be watching out for this week that might have a positive or negative impact on the S&P 500 and other U.S. markets? Is there a delay?
Bullish percent. So this is an indicator from 0 to 100 says of S&P 500 stocks are trading on a near-term buy signal. So just take an average daily chart. in the near term, has it broken out or has it broken down? And so this is way low now at 53. Only 53% of stocks are on buy signals. This is way up in 70s a couple weeks ago. So as this starts ticking down, it's really not a time to speculate very much into stocks at all. It's like trying to catch that knife as it keeps going down. Doesn't matter how close to the bottom you catch it, you know. So that's my main indicator. It's down. Percent of stocks above their 50-day and 200-day moving average, that has also moved down.
What was the first thing, Neil? What was the first thing you said? You broke up like right when you first started talking. You were telling us about an indicator, but it cut out.
It's called the bullish percent. You can just go to stockcharts.com, type in bullish percent,
Yeah.
and it'll show you 0 to 100 scale. And in all my experience trading stocks, this is my go-to indicator. It's sort of the sweet spot in the 70% mid-range. When this is ticking downwards, it's just not a time to speculate and gets going again. You're not going to miss out that much of the trend, but in the 2008
Interesting. So that's a secret of trading. Oh, you guys couldn't hear that, could you?
I got a little bandwidth issue, I think, on my end here. I didn't hear a lot of Neil's stuff, but what I heard, I really liked what he is.
Oh.
Yeah, you always learn something on the show, and that's why I love coming on, being the host. You were talking about bullish percent, and then you cut out once again, Neil.
Okay, you guys are coming through okay on my end. Bullish percent is a scale of 0 to 100, says what percent of stocks are on a buy signal, near-term buy signal, and this is ticking down to 53%. So obviously, the technicals of all the stocks in the market are going down. You just don't track the S&P 500 itself because the apps can control that index. And signals, that's pretty low. It gets below 30, it reverses back up again to get a good, nice trend.
Yeah, we're losing you again, Neil. But you know, it's good stuff though. Unfortunately, we'll come back to you in just 1 second. I am a technical trader. I'm going to keep an eye on the 200-day moving average in the S&P 500. It's no big deal if we go below it or anything. I like what Jason said. It's kind of interesting. He talked about the 50-week moving average, and a while back I put a chart in my column of what I call my bow tie moving averages: a 10-day simple, a 20-day exponential, and 30-day exponential. And if you watch those, if they cross over after a market makes a major high, a major low, it can give you some very interesting buy and sell signals. And on a weekly basis, we had a sell in 2000, a buy in 2003, and a sell in 2007, early 2008. And I plotted the 50-week moving average. It just so happened it was a 50-day moving average. And one thing that I've learned is everything works better with trend. If a market is trending, you really don't need that complex of a method. You just eyeball a chart. And one thing that's kind of cool, and I'm glad Jason brought up the 50-week moving average, was just the slope of that 50-day moving average, which would be, I guess, a 250-day moving average on a daily chart. But if just following that slope would have kept you in plenty major bull markets and kept you out of bear markets or short the bear markets if you wanted to be. And obviously you want to have some stops in place and not sit around and wait for a weekly indicator to change. But it's amazing how something as simple as that could keep you on the right side of the market. So I'm definitely going to be watching the 200-day moving average. We're sitting on it in the Russell 2000. The Russell 2000, I'm a little bummed out about because it's taken out its recent lows in here. It does have a lot of support. Bases the IWM around 117 or so, which would be below the average and not the end of the world. But if we stayed there, then you'd have a lot of overhead resistance. So there's definitely a lot of weakness within stocks. But I think we're really oversold in here due to bounce. And I'm not going to get excited just because we're going to bounce, but I'm still long from way back in last September, and I'm going to hold on. And then my stops will take me out if I'm wrong. And then if the market turns right back up, I'll stay long. And the other thing, too, is a lot of people, as soon as the market gets iffy, they think they just jump out and they get back in. And unfortunately, it's not that easy. The market could be a very bad teacher, as I know Jason knows because we were just talking about trading psychology. And, if I'd have bailed out every time since September, I wouldn't have made any money trading this year. But we've had some really good trends in spite of the open market overall market going sideways. So again, just keep an eye on those 208 moving average. Nothing magical about those. Keep an eye on the bow tie moving averages, and look at like 2-day and 3-day, 4-day and 5-day would be weekly charts with those moving averages. You're going to have a lot of lag in them, but it's also going to help to keep you on the right side of the market. Okay, let's go back to you, Jason. And the question of the week is about the VIX. And let me read it to make sure I get it worded properly.
Good, because my understanding of the VIX, I think, is rudimentary enough that the question you ask, I'm going to go ahead and have a qualification on my answer. So go ahead and.
Okay. Do you think that now it's interesting to define fear and VIX is the same thing, but do you think that fear, i.e. VIX, leads the market or is a reaction to the market?
Oh, man. See, here's the thing. I know that VIX is the fear indicator, but my understanding of it is very basic. I know that it's a lagging indicator in a lot of cases. But the big question is, what is the time frame that it's used on? If you use VIX on short time frame, it's not going to mean anything, because the real fear in the market has to do when people when they believe that their personal net worth is threatened. That's the problem. If you're looking at a guy day trading S&Ps, or you look at somebody who's trying to make 5% gain this month on a speculative account, he's going to use VIX as an indicator to help him with positioning around shorter time frame. If you look at VIX on a larger time frame, like daily, weekly, monthly, when people are scared to death that their net worth is going to be affected, it's too late. The market's already made their move. So if you look at VIX saying, do you think it's fear that leads the market or reaction to the market? The big push that's going to cause the big push, that whatever that is, that's the market already moving, and people are now scared that they're going to lose their net worth. They add to that. They add to the fuel to that fire by selling. I don't think the average typical person that's involved in this knows how to understand fear as an indicator so that they're flat when the market tops or mildly short. I don't think they know how to do that. So I think that for the most part, you're looking at the VIX as an indicator. Does it lead the market? No. Maybe on a small time frame, you might get a handful of guys that are positioned on the short side early, but they're going to be out at the end of the day anyway, because they're not thinking about 10,000 point move. What they're thinking about is, I'm just trying to make money today. I think by the time the correction is in play, the market's already lost so much that it's going to put the VIX indicator way over what would be considered, typical as an indicator. So by then it's too late, and now people are. That's what happened. I mean, all you got to do is study every crash that's ever happened.
Yeah.
It starts to roll off, and then the volume increases on the way down. Then there's a pause. Right in the middle, there's a pause, and that's when everybody thinks, oh, it's okay, it's not a problem, it's just a little correction. But nobody steps up to buy because they're afraid. Right now it's too late. And so now the fear just drives the market all. That's what happened in 2007 and 2008. We got a nice pullback, and then all of a sudden it went sideways for a little bit, and then it really went south, So I think that's it's too late by then. You've already lost 20% of your net worth, so
yeah.
I guess it's a good thing we
I
live
think
on the
in a
first
situation
floor,
like that.
Okay, Neil. So do you think, Neil, to you, do you think the VIX or that fear, i.e. VIX, leads the market, or is a reaction to the market?
I think it's a reaction to the market. If people see the pullback where it's time to buy, and then it just keeps pulling back and keeps pulling and more volume, and yeah, it's absolutely reactionary. But when you get these big pullbacks, I mean, that are massive, like we had in the fall, you're thinking to yourself, maybe it's okay for now, but this is when I put in my sell. When it's that gap, when it really broke through the trends and gets right back up to where it was before, and nobody seems to want to do that. But that's what people really should. One thing I was just thinking of, Dave, was you have the VIX. I'm not sure if we've ever talked about the S&P or about the put to call ratio on this show.
Go ahead.
Where the Chicago Board of Options Exchange will do what's the ratio of puts to calls, And when it gets really outside, the market turns almost instantly. Oh, you what?
Yeah, that's a great comment. Put to call ratio.
We got here. We got. I mean, I haven't found an easy way to do it yet. I downloaded it from the CBOE a couple times in Excel, some of my own calculations, but once it just kind of spikes up, that's it. The party is over. Like when Google had that great earnings, what was it, a week and a half ago? Boom, spikes way up. That was the top of the market. Like
You
the
know,
very next day,
what's
wasn't
kind
it?
of interesting, Neil, is a lot of people don't even understand that the VIX is a measurement of puts and calls, and people don't really realize that it's at the money, hypothetical 30-day implied volatility of puts and calls. I don't know if it did. Were you through on that? Because I was just going to jump in on the VIX. Neil?
Yeah, go for it. Yeah.
Okay. I wrote some systems in 2000, right around that time. About 50, 20 years ago, I did a lot of mechanical testing and a lot of programming back then. I have a degree in computer science, and I figured I might as well use it. And that's kind of is how I ended up becoming a discretionary trader. But some of those leftover systems, such as the VIX stuff, I do remember well. What happened was they worked incredibly well, and then they volatility dried up for a few years, and then they tend to work not quite as well. But if you pay attention to the VIX, and I don't know if you guys can see this, but if you look at this, I guess it's kind of a bluish cyan line. When you get stretched far away from that line, and especially when the VIX closes below its open, that's pretty much the end of that one wave in the overall market. The fear is really set in, and then it's beginning to come back. The VIX is a very mean reversion type of market. People try to use technical analysis on it, classical technical analysis and things like that, and I think that's a mistake. But if you look, if you study these spikes away from the 10-day moving average, anytime it gets 10% or more away from that 10-day moving average, start looking for a turn in the market, and I think you'll be pretty amazed. There's some swings in here. Going back to like early July, and then the bottom, which was, the top, which was right around the 17th, there was another signal to buy. I don't actually follow this anymore, but I have some clients out there that tend to email me when the VIX is doing these things. As a trend follower, I'm just letting the stops take me out and the entries put me into new positions. So I'm not going to try to time it to a T with the VIX. But if you did use the VIX, again, use it as a mean reversion type of indicator. And when it stretched from one side to the other, look for a reversal in the market. Now, to answer the question, and then Jason, we'll go to you. I know you want to chime in. But to answer the question, do you think that fear leads the market or is a reaction to the market? I think fear, I think the VIX, if that's what the question is a reaction to what's going on in the market. And obviously there's some panic. And then when that VIX gets stretched, it's like when you can cut it with a knife. The fear is usually when you get a bounce. A bounce comes roaring into the market. And what's kind of interesting in markets is you get more spike bottoms than spike tops, and everybody thinks it's just the opposite. You do get a crash now and then, but then you tend to get more of a spike bottom, and then tops tend to be more of a process, which is kind of a little counterintuitive. But I don't know if we have enough time to get into that today. But Jason, let's go to you. You were chiming in on that.
Oh yeah, I was gonna offer this observation about what kind of segue what you'd mentioned. Is that when you talk about fear and liquidation, you have to ask who's the liquidator. Because what is the VIX trying to do? What you're saying is you think it leads the market from a standpoint of it's trying to understand the underlying structure of the market when it's too far and it will revert to the mean, right?
Right. When you get you get a big spike away from the moving average, and then it starts to come back in. That volatility its implied volatility just absolutely implodes. When that happens, you usually get a reversal.
Right, but you will get that at a top more than you will at a bottom. Even though you'll get the spike in the bottom that's more frequent, the distance from the mean is always larger in a bull market or an exhaustion move in a raging bull market than it would be in a sell-off. Because the mean is your upside is unlimited, your downside is not. So your upside, you'll get a bigger move away from the mean when the VIX signals at the top might be in place. So it's probably more accurate in helping you predict topping than it is bottoming. But I would throw this out to you, is that there's two markets right now that I think need to be on everybody's radar. And VIX might be a great place to help you understand when. they might be ready to buy, and that's natural gas and gold. I think both those markets are at important reversions to the mean, and there's not a lot of downside room left. In other words, the mean is the bottom. So if the confidence level, VIX is a fear indicator. When it drops to the lowest level possible to calculate, that it really might mean the confidence that market is going to sell off. Those two markets are going to move even lower is really high, and at that point, it's time to buy. I think
Gotcha.
gold under 1100 and natural gas at the lowest it's ever been at, inflation adjusted ever in history. That's a no-brainer. So you might be able to use VIX on the buy side in the coming weeks and months to find a buy point, because if you say when it's really high, it's an indication of fear. So when it's really low, it must be an indication of confidence. The public doesn't trade bear markets; they trade bull markets.
Yeah.
So there's not going to be anybody on the short side that needs the cover to get out. It's going to be all professional buying, and those guys have got time horizons that are years long. So gold and natural gas could be just huge, huge trades moving forward, and it could be a long way from current pricing before you get any fear in those markets.
I think gold is sold out, but I'm a trend follower, so I'm not going to buy it just yet. It's going to have to bottom out and start rallying. It's going to be a process, not an event, probably.
Yeah, it could take till the end of the year.
Neil, let's go to you. Any closing thoughts or anything else you want to tell us about your trading or TraderReview.com?
Well, one of the things we do, and I give this away in my newsletters, positions on our trades. So a lot of people, let's say you got an account, just for example purposes, 100,000. A lot of people think, oh, I'll just put 5,000 in each trade. But what we do is I paid a guy to program a calculator for me, installs on your system, and it will tell you how many shares to buy and what percent of your portfolio is in a position based on share price and then the stop and how close the stop is. If you're buying something at 29, your stop is at 27, let's say, and you only want to risk 1% of your portfolio, so it will drop to 99,000 if you're stopped out. It'll tell you how many shares to buy. And this is really great if you want to buy a really volatile biotech stock where the stop is 25% away, or you're going to buy like a REIT where the stop is like 3% away if you get the perfect trend. So we give that away, and I think it works quite well for us. So
yeah,
if someone wants to download it.
What a lot of people don't realize, good stuff, what a lot of people don't realize is that sometimes you're actually better off trading more volatile stocks. I have an article coming out within a week in Traders Magazine, and you can get that for free off my website. I'll put it up on the website as soon as it comes out. And I call it volatility better than the devil you know, because if you're trading like a sleepy little REIT or something, you're going to have to put up more capital to get a same move over a shorter period of time. And something bad could always happen. And the example I always use is an impropriety of a CEO, which has nothing to do with the company. But I don't want to give away the spoiler alert on the article, but it's I made a kind of an interesting point on that. At least I think it's kind of, it's bringing a little levity to such a serious subject. Okay, Neil, stuff. Jason, let's go to you real quick. Any closing thoughts on, or as long as you need, on the liononline.net or the markets or anything else? Floor's yours.
Oh, thank you. Well, real quick, with regards to my product offerings and my website, I've got a new relationship I'm working on for online marketing and online presence. And I always try to tell my listeners and my followers this: I'm a trader first. I'm not a salesperson. I'm not a web guy. So, for those of you that have had issues navigating and getting help and don't really you can't find what you're looking for, we're addressing all those problems. So for those of you that are saying, well, Jason's been on a few times, not sure if he's got anything to offer me, stay in the loop, sign up for my newsletter and all the other things that you can with regards to keeping you on my database, because in the coming next couple of weeks or a month or two, going to have some great enhancements to bring everything I do up to date, up to speed, that would be considered more state of the art for you guys. So keep in the loop. because I think you'll like what you see. It's going to be a lot easier to navigate and get a lot more data and help.
Cool. Yeah, I'm feeling some of those growing pains myself.
Oh God, I hate computers, man. I thought computers was going to be a fad. I didn't know we'd have to use these things every day.
As you guys know, I'm Dave Landry. I do a weekly webcast called Dave Landry's The Week in Charts. And what I like to do lately, we tend to be taking this psychological slant for quite a bit. But I'll talk about setups. I'll talk about the overall market. And then the three phases, or the three important aspects of trading: mine, obviously, trade psychology, money management, and also the methodology. And as the market gives us examples, I use the market itself to kind of steer which direction we go on or to discuss. I also take a request, and then even once you're there, if you have questions on trading, I will answer them. And if it's a more involved question, I will use it as fodder for the next week's show. I have a newsletter I put out a few times a week, which is my column and appearances and things like that. So you guys check that out. That's free. It's on my website, and that contains my daily thoughts, or what I should call my random thoughts column, which is published several times a week. It used to be daily. That's why I said daily. And then about every 2 or 3 weeks, we'll do a nightly webinar on some aspect of the methodology. For instance, like IPOs. We did one on IPOs a while back. I have a trading service. We'll talk about the trading service and how that works and my approach to the market and stock selection and other things that I have out there. So check those out. They're free, and I do give out a lot of free information in those. I think that's it. David Kosmider, we'll turn it over to you. Before we do that, I want to thank you, Neil, and Jason, two good guests that I like to have on here. I think we had a really good show this week, so thank you guys for showing up. And David Kosmider, thanks to you once again and to Timing Research for having me on. And let me give it back to you.
All right. Thanks, guys. I just want to remind everyone who's watching that you can go to TimingResearch.com/reports to download the most recent or any past report. Also, please remember to go to TimingResearch.com/current survey later in the week or over the weekend to fill out the next survey and have your answers as part of the next report. And just want to thank my guests again, Jason Jankovsky of TheLionOnline.net, Neil Batho of TraderReview.net. Also, Thomas DeLello of OrderFlowEdge.com was supposed to be on today. He had to reschedule, so he'll be on a future show soon. And just want to thank, again, Dave Landry of DaveLandry.com for hosting.
Thank you.
Guys.
Hey, Dave, are you still on? Dave Landry, are you still there?